Welcome to SG Financial 101 channel. Okay, this channel's focus is on financial education and promoting financial literacy, right? So whatever financial institutions or financial products that are covered in this video are purely for education purposes, covering any financial institution or any financial products. It's not an endorsement from me. Definitely also not an investment advice from me, right? So if you want to know more for your personal investment decision, please speak to your own personal financial advisor or investment advisor. Okay. This video I will talk more on how to understand unit trust, right? So let's say if you look at unit trust, what are the things to look at to understand more, right? So so what is unit trust? Unit trust in Singapore we call it unit trust. In US is also known more as mutual fund, right? It's also one of the regulated collective investment scheme. So collective investment scheme is basically people pool money to invest together, right? Okay, so unit trust being that is one of them. So they are actually will be fund managers to manage your money following a certain objective. Okay, so when you look at any unit trust, right, there are certain documents. So the documents there are first the fund fact sheets, right? Fund fact sheets will cover investment objective strategies, key information, their product code, fund manager's name, and a chart showing the performance of the unit trust since inception. So it's very comprehensive. So imagine, let's say this fund is a person. Fund fact sheet is like a comprehensive CV, right? So basically, it's like a CV of the person. Then next, you have this product highlight sheet. So product highlight sheet is a more simplified version. So that's why we call highlight sheet. So it's meant not to be too comprehensive, right? This document actually complements the fact sheet and prospectus. Later I will talk about prospectus. Okay, usually 4 to 6 long and written as jargon-free English as possible for investors to understand the key feature. Right? So it's a simplified version. So let's say if you don't have time to actually look at the CV of the person, which is a fund fact sheet, you can actually go to product highlight sheet to look at the highlighted key facts. So it will cover a product suitability section and the key product feature structure of the unit trust. More information on where and what kind of securities the unit trust will invest in. So you can see there's significantly overlap. So product highlight sheet is a simplified CV. So basically, think of it like when you ask people to actually introduce themselves in 10 minutes. So this is like something like a product highlight sheet. Then the next is actually the prospectus. Prospectus, you can see here. This is the thickest document, can be 300 pages. So basically, it covers everything, right? It covers everything with a lot more details and reference. So the prospectus provide much more detail than the fund fact sheet and product highlight sheet on important details like the investment objective, approaches, fees, charges, risk. Document is edited and vetted by lawyers, so it's much more technical in describing the unit trust, right? So this is actually more used by people who really have a lot of time to understand it more in depth. And there's actually a lot of more descriptions and explanation on the details. Because for lawyers they tend to be very meticulous. They tend to actually make sure they give every keywords in the document. They can maybe give at least 1 paragraph or 2 paragraphs for explanation, or even pages of explanation on the what is the definition of the keywords to avoid any ambiguous dispute. Because in the event of a dispute, this prospectus will actually provide relevant information to settle the dispute. Okay. So again, right, I just randomly actually pick one fund. Just the purpose is actually to go through the document. The document I will just go through the product highlight sheet because it's the easiest to go through because it's the most simplified version. So as I said, whatever institution I cover or whatever product I cover, they're not endorsement. They simply I randomly just choose them to go through the steps on how to understand what a product highlight sheet is and what are the actual meanings of the jargon actually being used. So in this case, it's actually I'm right now on the website of OCBC Bank. So OCBC Bank is the distributor. So what is distributor? Distributor are people who you think of it, can think of it like supermarkets. Supermarkets, they are distributors of goods. So OCBC is a distributor. So they are actually the seller, the marketer of the funds. So these funds are actually not managed by them, not managed by external entities, external parties. So in this case, Schroders Asian Income is actually managed by external entity, which is a Schroder, which is a professional investment management firm. So Schroder is the one that's actually managing the money, and OCBC is actually marketing their financial product. So in this case, we call them a distributor. So let's get the relationship correct first, right? Okay. So without further ado, let's click into the product highlight sheet. Okay, this product highlight sheet is an important document, of course we know. Okay, we also focus on the date first. So usually what they provide is should be the latest product highlight sheet. So 12th November 2021. Okay, so it's now it's July 2022. Okay. It highlights the key terms and risks of this investment product and complement the prospectus, right? It's important to read the prospectus before deciding whether to purchase this product. If you do not have a copy, please contact to ask for one. You should not invest in the product if you do not understand or not comfortable with the accompanying risks, right? So these are the disclaimers provided by the by Schroders, of course, because they are the one who actually craft out all these fund details. You should. If you wish to purchase the product, you will need to make an application in the manner set out in the prospectus. Okay, Schroder International Opportunity Portfolio, Schroder Asian Income, the fund. So if let's say the fund is actually an atom, maybe I should use this description. So the portfolio is like a molecule. But in this case, we are focusing on the fund. So in terms of their relationship, what they're telling you is just that this Schroder Asian Income Fund also forms part of a bigger portfolio. A portfolio is the one that actually is a comprehensive investment tool that actually invests a lot of funds, in which Schroder Asian Income is actually one of them. So you usually when we look at the Schroder Asian Income, so these three words actually what we tell you. Schroder usually the first word is usually refers to the entity that manages this fund. So this geographical term usually covers where's their focus in the investment, right? So Asian Income. So even without looking at the details, I kind of have an impression to know that this fund actually has a heavier focus in Asia. And then the word income. So there are different kinds of investment strategies and investment objective. Certain funds focus on growth, which means that they tend to invest in this, let's say tech related sectors. So you will see the word growth because these sectors are associated with growth. The word income usually more refers to that investment product, investment vehicles that pay a yield. What is a yield? Basically, you can understand it as a dividend or interest. So usually they invest in companies that actually pay a dividend or invest in debt instrument. Debt instrument basically, you can understand it as loans, invest in loans. So basically, whoever hold the instruments, they get to receive the loan repayment from the debtor. Yeah. Okay, then the detail. Product type, unit trust. Launch date, 2011, 21st October. So this is basically the history of the launch date. Manager. So manager, who is managing the fund? Strider Investment Management, Singapore Limited. Custodian, the Hong Kong and Shanghai Banking Corporation Limited, HSBC. So what is this custodian? Custodian is the person who actually holds the investment, So you can custodian. So basically, you can think of this custodian role is like the people who is actually safeguarding the assets and money. Whereas manager is the one that decides where and how to invest. But why are they different? Okay, this is actually to prevent the managers from so-called, let's say if the managers become corrupted or they try to steal the money for themselves. If that happens, right? Actually, with the custodian is actually more difficult because people who hold the keys to the money, who have the ability to withdraw the money and liquidate it out, are actually not the managers. Actually a different entity. So this actually make it harder for the managers to steal the money. So it actually provides more safeguard for investors. So this is a typical way how funds are set up these days, especially since 2008 of the Bernie Madoff incident, because we found out that actually your money can get actually stolen by the fund managers. Okay, trustee. So what is a trustee? So trustee is also different from custodian. Trustee are actually people who watch the managers to make sure that they are doing their job. Okay, what do we mean by doing their job? So if let's say you know that every fund has their own different investment objective. So if let's say you are supposed to be focused on in Asian continent and supposed to be focused on investing in income producing assets. So HSBC has actually make sure that Strider does what they say they are going to do. So because you cannot have a case whereby actually you tell your investor you're doing this, but and then that you are doing B, right? Yeah, because you have to do what you say, what you are saying you're doing. You have to do what you're supposed to do. Okay, dealing frequency, every dealing day. Okay, what does that mean? This actually means that when you actually want to buy into the fund or cash out into the fund, it's actually done on the frequency of a daily basis. So it's different from where you personally, if you're actually trading stocks, maybe you buy at 10 a.m., you sell at 2 p.m., this kind of thing. But no, this is different, right? So here you can think of it, you can only make one single buy or sell decisions per day. Later we will elaborate on that. Capital guarantee, no. So usually for most funds are actually non-capital guarantees. Most funds are actually usually for investment products, they are not capital guaranteed because the reason why is that the funds value actually follow the underlying market value of the instruments. So theoretically, you can lose everything. It can go to zero. Expense ratio. So what is expense ratio? Expense ratio are actually money that's used to pay for the operating and the management costs of the fund, because in this fund there's actually managers who they are managers who are actually drawing a salary from managers. They also need to have an office for rental. They also need to have their own distributing and marketing costs. And all these are actually paid by the investors, right? So you can see that here here it highlighted that actually their expense ratio is on 1.43 to 1.45%, right? Maybe I just use 1% to explain the concept. So if you have an expense ratio of 1%, right? So it means that actually on a yearly basis, you're charged 1%. So if you have a portfolio, okay, maybe you have an investment amount of like $100,000. So we can see that you're paying for 1% expense ratio, you're paying 1K on all these expenses. But you won't see a bill actually being sent to you. So because this expense charges is actually charged by deducting the net asset value of your investment. So you don't actually see a bill actually sent to you saying that you are being charged like the utility bill that people ask you to pay using credit cards. So this is actually automatically deducted. So they will deduct a little bit every day. So let's say if this is 1.4%, 1.4% per annum, so you just have to divide the 1.4% per annum over 365 days. So the deduction per day is very minimal. So you won't be able to see it, but it's actually being deducted on a daily basis. Okay, product suitability. Who is the product suitable for? So it's quite important to know whether this product is actually suitable for you. Okay, the fund is only suitable for investors who seek income and a medium to long-term capital growth, and understand the risks associated with investing in Asian equities and Asian fixed income security. Right. In short, your personal investment objective must be aligned with the fund's investment objective to seek income and the medium to long-term capital growth. Right, you're not just here for the short run. Right. What are key product features? What are you investing in? You're investing in unit trust constituted in Singapore that aims to provide income and capital growth over mid to longer term. So mid to longer term, so this is definitely not a short-term solution for your personal wealth goal. By investing primarily approximately 2/3 of the assets in Asian equities. So as we guessed and predicted, it focus on Asian market, including real estate, investment trust, and Asian fixed income security. Right? So what is fixed income? Fixed income is basically another word for bond. The manager currently intends to declare distribution at a variable percentage per annum of the net asset value. NAV stands for net asset value per unit to holders of each distribution class on a monthly basis. Okay, so some of you might get lost. Sounds very cheap. What they actually mean is every month they will declare the distribution. Declare distribution are actually this they will actually pay the fund that will actually pay you back cash flow. So they are actually paying your money with your own money, because these cash flow are actually deducted from the net asset value from the fund that you actually invest in. So why do people actually want to invest in fund that actually deduct your asset to pay yourself? Because one possible explanation that maybe because for people who are retiree, they like this idea because they are actually looking at for their own retirement planning. Such date as determined by the manager. So which means that they don't have a mandate to say the cash flow needs to be a minimum of how many percent of the net asset value, right? So they have the discretion to decide how much they want to pay. No distribution will be made for these other currencies, right? Okay, which are in the accumulation class. Okay, this one I don't quite understand because this is actually something that's more specific to the Schroeder family asset classes. We come to like maybe they have the same product for different currency. This is something that I do not understand. Okay, investment strategy. The fund will actively allocate between Asian equities. Equity basically commonly known as stocks, Asian fixed income securities, cash, and other permissible investment to achieve this objective. The fund will use a cyclical approach to asset allocation, where the asset mix will be adjusted according to 4 phases of the economic cycle. Right? So they are telling you their basis for the decision, right? Going along with economic cycle, recovery, expansion, slowdown, and recession, based on a combination of fundamental and quantitative factors such as asset class valuation, macroeconomic data, and liquidity. Sounds very cheap. Maybe maybe you will get lost. Okay, let me try to explain now. So they will try to preempt on where the global economy is going at every stage. Then position themselves accordingly. So if you are actually if you feeling that we are heading into expansion, definitely you probably be a little bit more aggressive or risk taking. And if let's say you are sensing that we are coming to a slowdown recession, probably you are the manager will be less aggressive and more looking to protect the value of the assets. Means they will be more defensive in how they make their investment decisions. Combination of fundamentals. So fundamentals are and quantitative factors such as asset class valuation, macroeconomic data, and liquidity. So what are all these? Right? Fundamentals basically is like how you want to value the things that you actually invested in for stocks, right? So basically the financial ratio of the stocks, the price to earning or price to book. These are the sum of all the price to dividend. These are the financial ratios. For example, quantitative factors such as asset class valuation. So they are also look at this actually means that for one asset classes, maybe stocks or bonds, they are looking at how they are actually overvalued or undervalued compared to other asset classes. Macroeconomic data, so basically like employment data, inflation, statistic inflations, all these things, and interest rates. And liquidity. Liquidity is like for all the investor market participants. Is there actually ample liquidity? Well, liquidity is ample, right? So people can usually invest more easily. People tend to be more bullish easily because they have money to do investment, right? Because liquidity it just means that how much cash people have, right? They can actually do margin trading. They can actually have leverage on their position. So when liquidity is high, it's tend to be more will create some kind of like a short-term like bullish momentum for the market. But when liquidity drawing up, actually market will be in the short term will be actually going down. Cash will be treated as a separate asset class and will be deployed if necessary to limit downside risk during adverse market conditions. Okay, it's not clear that how they will actually do it. A separate asset deployed necessary to limit downside risk. So the actually I mean the common sense way, if I say if you think market is going down, definitely you will have more cash, right? You have less assets, more cash to prepare for it. In addition to active asset allocation, the fund also perform active security selection for its investments in Asian equities. So it's actually kind of repeat that of what we discussed earlier on, fundamental research. Asian fixed income and other permissible investment. For the Asian equities portfolio, the fund intends to focus on companies that are able to create true shareholder value. So they're going to actually look at the companies that they are actually business fundamental, their business model, and maybe even the leadership of the company management. Have a strong and stable earning stream and have a strong and sustainable dividend yield, right? Sustainable. So what do they mean? What do we mean by sustainable dividend yield, right? So if let's say the companies have good earnings and actually they are able to pay dividend to their shareholders, then it's sustainable, right? But if let's say a company is actually not making money or even losing money, they're just actually using their extra cash to pay dividend to the shareholder, it actually might not be sustainable. Just for example, for the Asian fixed income portfolio, the fund intends to select security that deliver attractive yield and capital growth, taking into account both fundamental and technical views such as valuation, demand, supply condition, liquidity. The fund will also perform duration management based on the manager's interest rate review. So they are also going to position themselves according to their own sense of perception whether interest rate actually going up or going down. Okay, parties involved. Who are you investing with? The fund is the sub-fund of Strider International Opportunity Portfolio. This is what we discussed before. Manager is Strider Investment Management. Okay, they are the one making the investment decision. Trustee is HSBC, Institutional Trust Service. So they make sure that Strider actually is investing according to the financial objective that they say they are investing according to. The custodian is the Hong Kong and Shanghai Bank Corporation Limited. The custodian is the one who actually makes sure that the money does not get stolen. What are the key risks of the investment? Value of the product and its dividend and coupons may rise or fall. The key risk may cause you to lose some or all of your investment, and your principal might be at risk. So so as we say, nothing is guaranteed, so you can lose everything in the worst case. You are exposed to market risk in Asia. The value of investment by the fund may go up or down due to changing economic, political, market condition, or due to issuers' individual situation. So of course, I'm exposed to market risk in Asia. So this is actually it's very common sense, right? Because you invest in Asia, you're exposed to the market risk there. You're exposed to credit risk. The fund is subject to the risk that some issuer of debt security or other investment made by the fund may or may not make payment on such obligation. Further, an issuer may suffer adverse change in financial condition that could lower the credit quality of a security. So this is actually saying that when you buy that instrument or you buy bonds, there's a chance that the borrower might default, leading to greater volatility in the price and security and in the value of the fund. So basically, if let's say the specific that instrument that you are the bond you are invested in, right? So what happens is that the debtor, the person who owns the money, actually become less credible. The credit rating go down, so actually the bond actually might lose value. The market price of the bond might actually go down. A change in the quality rating of a security also affect the security liquidity and make it more difficult to sell. So we find that when you actually try to sell the bond, right, there's actually no buyer want to take it. So this is actually speaking from the manager's point of view. There's no secondary market for fund. All redemption requests should be submitted to manager or its appointed agent. There's no secondary market for the fund. What does that mean? So this means that when you want to cash out for the fund, net asset value, we can only liaise with the Strider. So what Strider will do is actually to sell your units in the market and retain you back the cash. You can't say sell to another person because there's no market for you to sell your position to another person. Okay, product specific risk. You are exposed to investment grade, below investment grade, and unrated debt security risk, right? So investment grade are higher quality bonds. So think of like maybe Singapore government bond, US government bond, and maybe like corporate bonds, but companies that have a very good, strong financial standing, and maybe like Google. So these are called investment grade bonds, but anything less than that might be below investment grade or unrated debt security. But why do people actually want to invest in more risky bonds? Because more risky bonds actually have higher interest yield. Right? Because like maybe you invest in government bond of, let's say, a country like Kazakhstan, or you invest in, let's say, companies, right? The companies who actually whose financial standings are not really that strong. There's a risk that investment grade security that the fund invests in may be downgraded due to adverse market condition. If there's a downgrading of the credit rating of security and issuer rating to security that the fund invests in, the value of the fund might be adversely affected. The fund may invest in debt security below investment grade, which are generally accompanied by a higher degree of counterparty risk, credit risk, and liquidity risk than higher rated, low yielding security. Right? So basically, they're saying that they might invest in more risky bonds. The reason for that is actually if you only invest in the investment grade products, of course, it's safer, but expected return is also lower. as we know, higher risk associated with higher return, lower risk is also associated with lower return, right? Investment in unrated debt security may be subject to risk similar to those associated with below investment grade debt securities. You are exposed to equity risk, right? Basically, equity also known commonly as stocks. Stocks can go up, stocks can go down. So this is actually quite easy to understand, right? For the fund might invest in stocks and other equity security and their derivative, you're subject to market risk and historically have resulted in greater price volatility than experienced by bonds. So what they're saying is actually stocks are more risky than bonds and other fixed income securities. Fund may also invest in convertible instrument which may be converted into equity, right? A convertible instrument tends to yield a highly stable return before conversion, but its price usually has a greater volatility than that of the underlying equity. So this, okay, my lesson is, my lecture is actually for focus on financial 101. Right? So more complex terms actually, I think it's not necessary to include in this video. You are exposed to risk relating to distribution. The manager has the absolute discretion to determine whether a distribution is to be declared. The manager also receives the right to review and make changes to the distribution policy from time to time. This is actually a repeat of what we discussed earlier. Distributions are actually subject to manager's discretion. Right? They can decide actually more distribution this time or less distribution next time. Right? Where income generated by the fund is sufficient to pay distribution as declared, the manager may at its discretion make such distribution out of the capital. Where distribution are paid out of the capital of the relevant classes, the net asset value of relevant classes will be reduced. You are exposed to emerging market and frontier risk, right? So emerging markets, like I said, maybe like countries like Indonesia, so we usually are associated with higher market, legal or political risk, right? You're exposed to financial derivative risk, right? Because they are actually use of more complex derivative products. So this, so sometimes the managers actually make investment decision, they might use complex derivative products. So the complex derivative products, of course, they're subject to the same market risk. They can go up because market can go up, market can go down, but also because they might not capture the market movement perfectly. So there's also another risk on that as well, right? For those actually who are interested, you can actually Google more. This is just a 101 video, so we are not focused on this too much. Huh? Okay, what are the fees and charges of this investment? Payable directly by you. Okay, this is what you pay. Pay attention. You need to pay the following fees and charges as percentage of your gross investment sum. Initial sales charge, cash unit, and SRS. SRS is actually SRS account. You can actually open with the big three Singapore Bank, DBS, UOB, and OCBC. If you invest in your SRS account, you have like this for a small amount, it's actually tax. It actually is tax deductible. It's actually tax deductible. You have an amount that actually that you can do investment to help you save tax. So basically, for these financial products, you can use SRS to invest in. Okay, sales charge 5%. What does that mean, right? So currently up to 5%. Okay, so let's say because they say it's currently up to, so we don't really know actually what is the actual sales charge. When you actually buy this product, you have to get a investment advisor to find out that. So let's say assuming it's actually 5%, what does the sales charge of 5% actually mean? 5% actually means that if you invest in 100K, this 5%, 5K is deducted upfront. So actually your net asset value will be 95K. So right from the start, your asset value will begin from 95K. This is deducted upfront. That's why this word is called initial. Realization charge is actually when you want to cash out the fund. Currently, there's no fee on that, right? Switching fee is actually when you actually switch from one fund to another fund. Currently 1%. Currently 1%. But of course, you should check with the agent or distributor through whom you subscribe for shares of the fund, whether they impose other fees or charges not included in the prospectus, right? So what Strider is actually saying that you should check with the distributor. So in this case, as we said, the distributor is OCBC. You should, they are actually saying that if actually you buy from distributor, and for this 1% switching of fund fees, you got to check with your distributor what funds you can actually switch that's charged under 1%. What fund you can actually switch to that actually doesn't charge this. Right? Payable by the fund from invested proceeds. The fund will pay the following fees and changes to the manager and trustee. Management fee, 1.25%. So this actually fee is paid annually. Actually, we covered this point already. We covered this point already. This actually the management fee is actually covered. It's actually used to pay the operating expense of the fund and as well as marketing expense of the fund. Okay, and out of this 1.25, 35%, minimum 35% to maximum 100% of management fee actually is written by the manager, which means Schreider they take the range of 35 to 100, somewhere in between that. Paid by manager to the financial advisor. So in this case, the financial advisor is actually usually from the distributor. So in this case, if let's say it's OCBC bank that distribute the product, it's actually the investment advisor from the OCBC, right? So from 0 to 65% of the management fee actually paid to the investment advisor, right? But take a note here, investment advisor here, so the financial advisor. So it might not be the person, the actual employee who takes so much, because the bank usually have to take account also. So we're not sure actually what is the very detailed breakdown or because you don't get to see the advisor's employee contract. Trustee fee. Currently not more than 0.05%. So clear cut means that this amount of money that actually paid to the trustee. So we can see that this management fee 1.25% is actually broken down into two parts. One part is written by manager, the other part paid to the financial advisor. Right? Then the other part is actually trustee fee. This is actually, you can see that this fee is outside of this 1.25. It's something that's additional, where this 1.25 is broken down into part A and part B. But valuation exiting from the investment. How often are valuation available? Remember we talked about the cycle, the investment, the valuation cycle that's actually a daily frequency. The NAV per unit of each class of funds published on the manager's website. One business day after the relevant dealing date, so available directly from the manager. How can you exit from the investment and what are the risks and the costs of doing so? You might at any time during the life of the fund request in writing. In writing, I don't think it means writing a letter. Usually in the financial industry, it usually means submit a withdrawal form, to realize or any unit held by you, submit to the minimum holding and the minimum realization amount requirement as mentioned in the prospectus, right? The realization request must specify the units in the relevant class to be released. The realization proceeds are paid to you within 7 business days, right? So basically, very simple. Once you submit, actually you receive the money within 7 business days. Okay, how they calculate, important, how they calculate your realization price, right? So if you submit the realization request on or before 5 p.m. on dealing date, you will be paid a price based on the net asset value of the relevant class on the dealing date. So basically, what they're saying that they will at the end of the day, there will be a finalization of the price. So as long as you submit before 5 p.m., it will be based on the price of that day, which is actually they didn't specify whether it's actually 5 p.m. Are they referring to the price actually? There's actually one price at 5 p.m. which they will follow it. Because usually from my understanding that they will actually have a specific time in the day. So let's just use 5 p.m. for example. So let's say they will look at the 5 p.m. They will actually calculate the net asset value of the unit actually on 5 p.m. So even if let's say you submit the form at 10 a.m. And you think that the price actually is good, but actually the market actually dropped on 5 p.m. You still actually get the price calculator based on that time of the day. The sale proceed that you will receive will be the realization price multiplied by the number of units realized, less any applicable duties and charges. So basically, they will calculate, most important, they will calculate on the realization price first, then multiply the number of units they want to withdraw. If applicable to you as provided in the trustee of the fund, you may cancel your subscription for units by giving written notice or by submitting a cancellation form to the manager or its distributors. As we say, it's a form. Within 7 calendar days from the date of the subscription. However, you will have to take risk of any price changes in the NAV of the relevant class since the time of your subscription. Okay, contact information. Okay. So this is an appendix and glossary of the terms in this way. Okay, we have come to the end of the of this video going through this product highlight sheet. Okay, take note that this choosing this product is not endorsement of the product, not endorsement of the financial institution involved, also definitely not an investment advice for you. So if I say you want to seek investment advice, speak to your own investment advisor. So whatever I covered here is for general education only. So if let's say happens that you bought this product and for specific terms and conditions that you want to clarify, also speak to your own investment advisor because they will be better to assist you.